Welcome to HDIN Research's strategic briefing on the 2024-2025 AI compute semiconductor landscape. Today, we apply the Harvard Financial Analytical Framework to evaluate the market penetration of global leaders NVIDIA and AMD alongside the emerging domestic ecosystem in China. Our goal is to provide a neutral, data-driven perspective on how architectural shifts and geopolitical variables are reshaping the global compute supply chain. We begin with strategy analysis to understand competitive moats. Next, we move to accounting analysis, focusing on R&D treatment and inventory integrity. We then deep dive into financial analysis to compare margins and liquidity. Finally, our perspective analysis will project how the 2028 landscape will bifurcate into training and inference segments. The current situation is defined by a consistent 24-month structural reset cycle. As scaling laws push model complexity higher, the hardware architecture must undergo a fundamental bottom-up refresh. While training remains highly concentrated among global incumbents, we are observing a significant divergence in the inference market, where efficiency and power consumption are becoming the primary metrics for success. Our macro-environmental scan highlights a complex interplay of forces. Politically, export controls such as ECCN 3A090 serve as the primary headwind for cross-border trade. Economically, however, we see a massive CapEx surge from U.S. hyperscalers exceeding $405 billion. Technically, the market is shifting its focus from pre-training capacity toward test-time scaling, which places a premium on HBM bandwidth. The 2025 CapEx landscape reveals the emergence of a multipolar world. While the U.S. remains the dominant spender, the GCC nations, specifically the UAE and Saudi Arabia, are rapidly emerging as a third global pole. China's estimated $180 billion CapEx reflects a determined effort to build sovereign compute capacity despite hardware constraints. The primary complication is what we term the, quote, 1/8 capacity chasm. Due to restrictions on advanced logic nodes and HBM3E memory, domestic state-of-the-art chips currently offer approximately 12.5% of the raw compute power found in global flagship products like the H200. This bottleneck is not just in silicon, but in the interconnect fabric, where NVLink's bandwidth significantly outpaces standard Ethernet alternatives. From an accounting perspective, asset integrity is under threat. Rapid policy shifts lead to, quote, stranded assets. NVIDIA, for instance, faced a $4.5 billion inventory risk regarding its H20 series. For domestic firms like Byron or MetaX, photomasks and IP licenses for advanced nodes are subject to immediate impairment if jurisdictional enforcement changes overnight. Supply chain flexibility is now a core financial safety metric. This leads us to our central strategic question. How can domestic challengers bridge this performance gap while incumbents continue to fortify their ecosystem moats? Is the path forward architectural mimicry, or a fundamental pivot toward massive-scale interconnects and ASIC-led inference to bypass the silicon blockade? The answer starts with understanding the incumbent's strength. NVIDIA has successfully transitioned from a chip maker to a full-stack data center company. Their moat is threefold: the CUDA software ecosystem, the NVLink hardware fabric, and a relentless one-year architectural rhythm that forces every competitor into a perpetual state of, quote, catch-up R&D. AMD is pursuing a best alternative strategy, specifically targeting NVIDIA's memory wall. By offering significantly higher VRAM capacity on products like the MI355X, AMD appeals to hyperscalers running massive LLMs. Their commitment to the open-source ROCm ecosystem is a calculated move to lower the switching costs for developers currently locked into CUDA. Domestic strategy is anchored in the concept of sovereign AI. Companies like Threads, Byron, and MetaX are building for national resilience. Their focus is on software compatibility to lower migration costs and high-performance interconnects to solve the single-chip ceiling. For these firms, success is defined by creating a closed-loop localization ecosystem for critical sectors. The financial reality of this race is reflected in R&D intensity. To remain relevant, challengers are spending an astronomical percentage of their revenue on R&D, in some cases exceeding 90% or even several 100% for pre-revenue firms. This creates a paradox where technological survival necessitates extreme short-term margin compression and constant capital dilution. Asset integrity for domestic firms remains highly sensitive to global jurisdictional shifts. We estimate that over $100 million in optical mask investments can be rendered obsolete by a single node-specific ban. Furthermore, the requirement to maintain 12 to 18 months of HBM inventory creates a massive working capital lockup, increasing the financial risk profile of these entities. Our financial analysis reveals a tiered profitability structure. NVIDIA operates at a 75% gross margin, reflecting absolute pricing power. AMD follows in a healthy second tier. Interestingly, domestic firms like Cambricon have recently turned a profit in early 2025, while others, like More Threads, maintain high theoretical margins but suffer from high operational cash burn. Visibility into 2026 remains strong for the top tier. NVIDIA's Blackwell backlog is estimated in the hundreds of billions. For domestic players, the growth is driven by AIDC, AI data center projects. More Threads and Byron have reported significant unfilled orders, signaling a robust domestic demand that is decoupled from global market cycles. Efficiency and liquidity are the current focus. As the era of, quote, free money ends, domestic firms are shifting toward IPO readiness. The planned 8 billion RMB fundraising for More Threads is a critical milestone. For these challengers, the ability to manage cash burn while maintaining R&D velocity is the ultimate test of management quality. Looking toward 2028, we project a market bifurcation. While GPUs will maintain their lead in flexible pre-training, we expect ASICs, custom silicon from Google, Amazon, and others, to capture up to 45% of the inference market due to their superior cost-to-performance ratio in specific tasks. The 1/8 gap will likely be bridged through scale-out solutions rather than scale-up silicon. By using 10,000 card interconnects and advanced algorithm optimizations like those seen in the DeepSeek model, challengers can effectively achieve competitive performance levels even with individually less powerful chips. In summary, the strengths of the domestic sector lie in guaranteed sovereign demand and architectural breakthroughs at the algorithm level. However, the threats remain hardware-centric. The HBM blockade and the competitive pressure from downgraded global products like NVIDIA's H20 series. The road is indeed long, but the trajectory suggests a resilient, bifurcated future. HDIN Research offers 3 core recommendations. For investors, prioritize system-level efficiency over raw flops. For domestic firms, pivot toward inference as a service. For hyperscalers, build heterogeneous clusters that utilize a mix of Tier 1 global GPUs and domestic ASICs to optimize both performance and supply chain security. Thank you for your attention. This concludes our briefing on the AI compute semiconductor landscape. At HDIN Research, we provide the deep dive market intelligence necessary for navigating these complex technological and financial shifts. For detailed custom reports, please reach out to us at sales@hdinresearch.com. We look forward to your questions.